Hey guys, welcome back to the channel. So by popular demand, today we'll be looking at dividend investing. And I've made a short beginner's guide to help you get started. In this video, I cover 2 different ways you can invest in dividend stocks. And at the end of the video, I talk about how dividends are taxed here in Australia, including how franking credits work. So let's get into it. Now, if you're watching this video, I already assume that you know how dividends work. So to quickly recap, when you buy shares in a public company, you're entitled to a part of that company's profits. Some companies prefer to retain the earnings within the company to grow the underlying business. And other companies who can't reinvest their profits back into the business opt to pay a percentage of their profits out to shareholders as a dividend. Dividend investing is really simple in theory, and it's based on the idea of collecting dividend payments as a stream of passive income. The more shares in the company you own, the larger the dividend payment. For example, if you owned $1,000 of a company's stock and it paid a 5% dividend yield, your annual dividend would be $50. This could be broken up into 2 payments of $25 every 6 months, or $12.50 every 3 months, depending on the business. And if you owned $1 million in stock, your annual dividend payment would be $50,000 a year. Dividend investors can also take advantage of compound interest by taking part in something called a dividend reinvestment plan, commonly referred to as a DRIP. This is when, instead of receiving your dividends as a cash payment, you opt to use your dividends to purchase more shares, which gradually compounds your dividend payments over time. If you know about the power of compound interest, you already know that over a decent chunk of time, compounding even small amounts of capital at decent rates of return can have amazing results. So when it comes to actually investing in dividend stocks, there's basically 2 ways to go about it. One is relatively easy, and the other is a little more difficult, and I'll share my thoughts on both of them. The first way, which is the easy method, is buying dividend ETFs or exchange traded funds. Dividend ETFs are a diversified portfolio of dividend paying companies, which are actively managed for a small fee. So essentially, when you buy a share of a dividend ETF, you're buying a basket of hand-picked dividend stocks. Buying dividend ETFs is probably the simplest way to start dividend investing, especially if you're new to investing and you're unsure how to analyze individual companies. Most of the top ETFs in Australia have screeners to screen for dividend traps, and they target companies that pay a persistent and sustainable dividend. Investing in dividend ETFs is really similar to investing in index funds, except they emphasize dividends over capital gains. If you choose to go down this route, it's important to research how consistent the dividend's been over the last 10 years, what their fees are, and how stable the top holdings are. For even more diversification, instead of buying just one ETF, you can buy multiple and have a passive portfolio full of various dividend ETFs. There's a wide range of dividend ETFs here in Australia, and I made a video previously where I shared my top dividend ETFs, so you can check that out if you're interested. The next way to invest in dividend stocks, which is the more difficult way, is choosing your own dividend stocks for your portfolio. Picking your own stocks in general requires a lot more research and general investing knowledge, so this isn't something I think newer investors should try. Choosing your own stocks is hard, and if you don't know how to analyze companies, it can easily go very wrong and you can end up losing a lot of money. Now, to be transparent, I personally don't invest in dividend stocks because I'm a value investor looking for compounders. So if you want to best learn how to research and choose individual dividend stocks, I highly recommend checking out David Kwan and Tracy Edwards' channels. This might lose me some viewers, but I'd rather you learn from someone who actually knows what they're talking about when it comes to dividend stocks. Different styles of investing have slight variations in their framework, so it would be way more beneficial to learn from an experienced dividend investor than from a value investor like me who purposely avoids companies who pay dividends. What I can do though is share a bunch of mistakes I've seen newer investors make when it comes to dividend investing, and also how dividends are taxed here in Australia. So one of the biggest mistakes I've seen newer investors make is chasing a high dividend yield and falling into what's called a dividend trap. This happens when investors looking for the highest possible yield invest in a company that has a suspiciously high dividend yield, only to have the rug pulled from underneath them when the company cancels or cuts its dividend, which is what happened to Telstra back in 2015. Essentially, the first lesson of dividend investing is looking past the yield, because a dividend yield can be high for a number of reasons. One reason is when the company's stock crashes dramatically, but the dividend stays the same, and this dramatically affects the yield ratio. If a stock was at $100 and had a $5 dividend, its dividend yield is 5%, which is fine. Now, let's say the company has a terrible year, causing the stock price to drop to $50. With a $5 dividend, the yield is now 10%. The company performed worse, but the dividend yield looks more attractive, and this is a dividend trap. When a company starts going downhill or has problems, usually the first thing to go is the dividend. Management can either cut the dividend or remove it completely depending on how bad the situation is. This will probably make the stock drop even more. And if you bought shares, you'll probably lose your dividend income, and your shares will lose value as well. So dividend traps can sting in 2 different ways when they go wrong. A consistent and stable dividend is way better than a temporary high yield, and it's much more predictable long term. The other common mistake I see investors make is not understanding the business, and this goes for value investors and dividend investors alike. At the end of the day, when you buy a stock, whether it's for capital gains or dividends, you're buying a part of a business and not just a piece of paper. So it's still critical, no matter what investing philosophy you follow, to still understand the business you're buying. If I don't understand the business, there's no possible way I can accurately predict the future of that business. So if I'm looking at a business like an oil company or a mining company or something I don't understand at all, even if it's paid a stable dividend over the last 10 plus years, I have no idea what the future holds for that business, and if it'll continue to pay dividends in 5 or 10 years from now. Past performance isn't always an indicator of future performance, so it's critical to understand the business before you invest. Alright, the last thing I want to cover today is the tax laws around dividends. Essentially, in Australia and everywhere else for that matter, dividends are classed as taxable income and are taxed accordingly. Every year you have to declare your dividends, and it gets added to your overall taxable income to be taxed at whatever income bracket you fall into. Now, Australia has a unique system for dividend investors called the franking system that's really helpful to investors. Basically, when a business makes profits, it gets taxed. Then it pays a dividend to investors and the investors get taxed. So it's a pretty inefficient system where dividends are double taxed. But in Australia, however, when a company pays tax before paying its dividend, investors receive their dividend with an acknowledgement of the tax already paid. And this acknowledgement is known as a franking credit. A franking credit allows you to take the equivalent amount out of your taxable income as a deduction. And if you have no taxable income, you're entitled to these credits as a cash refund. Some companies offer fully franked dividends, meaning you pay zero tax on the dividends you receive because the company has paid tax on 100% of the dividends to be distributed. However, some companies, because they have overseas operations and only pay some tax in Australia, offer either a partially franked or an unfranked dividend, meaning you only get a partial tax break or none at all. Individual companies and dividend ETFs will usually tell you whether they offer franked dividends or not, and it's an important factor to consider because it can save you a lot on tax over the long term. Overall, the franking system is a great bonus to investors based in Australia, and it removes the ridiculous double taxation of dividends. So that's it for today, and to quickly recap, there's two main ways to invest in dividend stocks. You can either do a lot of research and analyse various dividend paying companies and build your own portfolio full of companies you've handpicked, or you can take a more passive approach and just buy dividend ETFs. Both methods work well, but the active approach takes way more effort to do successfully. If you're interested in other creators who are successful dividend investors, I highly recommend checking out the channels I mentioned earlier. If you enjoyed the video and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one or join our community, then hit that subscribe button. And if you're still interested, I'll put another video up in the corner that I think you'll like. If you've watched the video all the way to the end, thank you so much for watching. If you're new to investing and you want to learn how I personally invest using the Buffett Munger framework, or if you just want to download and use my intrinsic value spreadsheets, then check out the free course on the channel. I cover every aspect of value investing in detail. As always, this video is not financial advice and I am not a financial advisor, so please always do your own research before making any investment decisions. So that's it for today. Thank you so much for watching and I'll see you guys in the next one.